It's time to record this month market update. And you can see that in my background, I'm in my car, I'm recording my car. And the reason being, I'm on vacation and my mother-in-law won't let me work, so I need to sneak out of the vacation home and record this in my car in the early morning. Okay, so let's go back to the data. So this is the May data of March 2023 of the Bay Area. So let's take a quick look at the year-over-year number for each of the county. Alameda County dropped close to 17%. Contra Costa dropped close to 11. Marine close to 10. Napa 15. San Francisco 18%. And then San Mateo, as always, it's standing very strong. Santa Clara also very strong, only dropped 7%. Solano, okay, for some reason, even better, dropped only -3. Solomon close to -2%. So overall, I think we have come to a point that this May time, right? So that is the beginning of actually the middle of spring of 2023. I think this is a good representation of the 2023 data. Springtime is always the best time for the real estate market, and I would use this as a landmark. I guess about a year or two ago, about a year ago, in one of the episodes, I said that the market is going to correct. It's going to drop about 15% from the peak. I think that's where we are right now. As I said that we are not going to have a catastrophic drop like in 2008, and it's more like a 15% correction. I think that's where we are. We are at this 15% correction, and the market is probably not going to drop any further. And I'll elaborate on the reasons. So, and if you look at the month-over-month price, actually, prices start to come back. And you can see Napa 9% gain. Wow, look at that. And Alameda 3%, San Francisco 4%, San Mateo 5%. Wow, look at that. So I predict the market will come back this year. And it's probably not gonna go down any further. It will stabilize this year, and then have an even very likely a moderate gain in 2024. And and I'll go into the reasons a little bit more. So one article that kind of caught my eyes is that this billionaire Ron Barron says inflation will propel major stock gain in the coming decades, but everything will be twice as expensive. If you look at this article, it presents a different view than all of a lot of the stock market analysts, saying that there's all this risk of major market correction, but his viewpoint is that this inflation is going to allow company to charge more, and therefore the company profit will stay up, and people will still put money back into the stock market. The stock market will continue to drive the economy. Yes, things will be twice as expensive, but the company also make a lot more money, and people will continue to get paid more. That's an interesting point of view. I think, to me, I agree with this perspective now, but I have a slightly different reason. To me, the reason really being that the Fed is putting too much liquidity out there for too long, and I always like to come back to this chart and see what's the current status of the balance sheet reduction. So back in 2009, actually before the QE in 2009, so we were at the Fed's balance sheet was close to $1 trillion. Close to $1 trillion. So it's 909,000 million. So that is close to 1 trillion. That's right, close to 1 trillion. After the first QE policy, it went up to 2 trillion. and then after COVID, it went up to 7 trillion, and then it keep going up until at the peak it was about $9 trillion. So this money is the Fed is putting into the economy. It has not taken the money back. It tries to reduce it, and then it went back up. It went back up again. It went down to 8.3, and then went back up to 8.7 trillion again. So what does this mean, right? So $9 trillion. Let's put it into perspective. So the U.S. GDP is, let's pick the number, March 2023. So Q1 2023 is $26 trillion. Okay, and then the market capitalization of the total U.S. stock market is 153%. So let's take that. Let's take a March GDP 26.51 times 1.53. That is, and to 554. That will give you the U.S. stock market capitalization right now. It's $40 trillion. So let's assume, which is not true, but just for the sake of discussion, this $9 trillion is that the Fed let out into the market, into the economy, all went into the stock market. It represents about a quarter of the U.S. stock market capitalization. So that's a crazy amount of money. Of course, this money was let into the economy. It was not let into the stock market alone. Only a much smaller amount went into the stock market, because this money go into all kinds of different assets. Stock market is just it's still a pretty big portion, but this comparison allows us to put things into perspective. This amount of money is huge. It's really, really huge. Okay, so when the money is still in the economy, the Fed still hasn't taken it back. It's still circulating despite its raising interest rate, but this money is still out there. It's in somebody's pocket. It's in some asset class. It's in someone's investment portfolio. Okay, whether it's in Bitcoin, it's in the stock market, it's in bonds, it's in precious metal. So all of this, the money, this is what it's inflating the price of all these different asset classes. Yes, stock market has had its correction, but it's pretty much recovered from it. We're out of the bear market now. So now let's come back to the housing market. So I think this is where we are at right now. So let's look at the mortgage rate. Let's look at the mortgage rate here. So we have been at this around 6-7% kind of interest rate for about a year. So the highest, let's see, so the last shock we had was about here. It was about in 2022 that we had one shock here, about when the rate started to climb up. Okay, it was about a year ago, around this time. So June 2022, rate went up to a 30-year rate went up to about close to 6%, and then we have another shock, went to about 7%, and then it kind of hovered this 6%ish kind of range, and for about a year. Okay, during this time, the Fed still kept raising rates, but it has not caused the mortgage rate to go up, and that is because if you look at the 10-year Treasury rate, it has been stable for this time. Okay, for this 1 year time frame, it's been stable, hovering around 3.8%, 3.5, 3.8%. So I think by this time, people are convinced, home buyers are convinced that okay, the interest rate of the mortgage is not going to go any higher, even if the Fed keep raising rate. Yes, it will go a little higher, but it's not going to go like 8%, 9%. It's not going to go anything like that. So most likely going to be a bit hovering between 6 to 7, and people start to accept that. Now, now if people start to pull back and look at the bigger picture, look at what the interest rate has been historically. Actually, the last time we were this high, it was about 2007. It's actually not that long ago. It was before the last real estate bubble burst, and before then, in the 1990s, it was even higher, 8-9%. Okay, so people start to accept that, hey, 6% is not too bad, and we can still manage it. Yeah, of course, given this economy, the people who are buying homes are not the folks that are just getting back into the job market, getting back into the restaurants. It's not these folks. It's the people who have been benefiting from the Fed's policy. People who have bought home before, people who did the refinance during this whole COVID time. People who took money out of their home equity, got a really cheap 2-3% mortgage, 2-3% interest rate mortgage, cash out refinance on their home, on their rental property. These are the people that still have a lot of cash to purchase. I'm not saying you're gonna buy real estate with cash. They are still gonna leverage, but they are the beneficiary of this Fed policy, of this huge balance sheet that we are seeing. Okay, and also business owners who took COVID loan from the government. Part of this money went out to a lot of small businesses. That's part of the COVID rescue package. So this money is still out there, and these are people that still have the cash. They benefited from the Fed policy, and during COVID time, and they will continue to buy. And then these are people that will also realize that, hey, 6% is not too bad. We can manage it. So we will be seeing instead of first-time home buyer, we will see fewer, I guess, smaller percentage from first-time home buyer, but a bigger percentage of people just buying investment properties, second home or move-up homes, and then keep the first home as investment property kind of situation. And this is gonna help stabilize the housing market and start to slowly take it to a moderate increase year over year. Okay, so I think this is basically my outlook for the housing market. We are at the bottom of this correction since 2022. We expected to see the housing value to go up again at a moderate pace, and of course, a lot of things can still happen. Recently, we have interesting news from Russia, and there's still a lot of unknowns. But I am becoming more optimistic about the housing market, and as well as the stock market, thanks to the Fed has been very slow in reducing the balance sheet. This is really the problem with policymakers, right? So it's easy to inflate the balance sheet to put money out there, but it's really hard to take the money back. Taking it back has caused a catastrophic effect on the economy. No one wants to put their name next to that kind of news. So people are very generous in putting money out, and very reluctant to take money back. They don't want to cause a problem. So now Fed chair, the term, I think it's like 10 years. So he's a few years into it. I think by the time of the end of the Fed Chair Powell's term, we will still have a very big balance sheet, and that is someone else's problem. He's not gonna bother. So yeah, this money will be out in the economy for a long time, and that is gonna help stabilize the economy. Oh, there's one more thing that I would like to share. Oh, it's this chart here. So yeah, people are arguing that, hey, the PE ratio right now in the stock market is really high, 32%, and this is the correction. All this arrow, this red arrow, okay. These are the PE ratio corrected from 45% down to this 25%, and people have been saying the historical average is about 15%. Sorry, not a percent. This is the PE ratio. So 45 go down to 25. People have been saying historically it should be around 15, and we are due for another correction. It could be another sharp drop. But here's the thing: the last time this PE ratio correction was right around 2009. Okay, and also remember that since 2009 we have let all this money into the economy, and that is what makes this scenario different. This time is different because all this previous time the Fed never used this big gun to help the economy, but it did in 2009 and COVID again. So unless we shrink, the Fed shrinks its balance sheet, we are unlikely gonna see this kind of big correction in the stock market. Yeah, so it's really, I think when all these people have so much cash, people will continue to invest, continue to be moving the cash from one class of asset to another. Just, yeah, there will be shift between shift in value between different asset classes, but overall the money is still out there in the economy, and things will just be fine. Yes, now it's gonna have a bigger wealth gap for the overall economy, but that, I think, unfortunately, that's a reality that we have to live with. The rich will get richer, the poor will get poorer. That's just how the kind of game it is. For the poor to really get on the rich side, they really need to know how to play the game. They need to get education. They need to know how to play the game that the rich knows how to play really, really well. So and unfortunately, our government is all managed by, it's all run by the rich people, whether it's Democrat or Republican. They're all the same. They're all rich people. So anyway, so this concludes today's market update. I will see you next time.